So why today's topic? Why creative and new finance? As we thought about how to introduce this topic, how to really keep our region growing, keep our region on the trajectory that it's been on. We must not let macroeconomic forces slow our growth. We must keep our vision on the long term, and we must continue to build and develop to keep our growth, to prepare for our region for the next 400,000 residents that are going to call Northwest Arkansas home by 2045. We can't let 7 and 8% interest rates prevent us from building to today's demand. And in fact, we must use this time to differentiate ourselves from our peer regions by getting creative and continuing our growth. We must keep the development flywheel spinning in Northwest Arkansas. Today, we hope to provoke some thought and offer some solutions around alternative finance offerings for both our residential, commercial development, and municipal leaders that are joining us here today. This is the fourth of our 5-part speaker series, and we're bringing experts in from across the nation to share best practices to keep our development and growth work going. After today, our team will share a recording as well as a survey, and we ask you to fill that out. We do look at those. We want to tailor future opportunities to the interest of those that are attending. And before we kick off, I just want to give a little preview of our format today. It's a little different than what we've done in the past. We have 3 experts. We've given each of them 20 minutes. We're calling it a lightning round. It's pretty slow lightning if it's 20 minutes, but they're going to give you a high-level overview of their programs, their program areas, their approach, and then we're going to take 3 questions after each of them. At the end, we're going to open it up to more questions that you could ask of any of them, but we really want this to be a bit of a relationship beginning kind of experience with many of you as you think about how to get projects financed. First, it's my pleasure to welcome Mark Conine. He's the president of Arkansas Development and Finance Authority. He's here to highlight some of ADFA's affordable housing construction financing options. Mark is responsible for the day-to-day operation of all programs and financial activities of ADFA, including taxable and tax-exempt bond issuance, state and federal single-family and multifamily LIHTC program, single-family mortgage programs for first-time home buyers, including down payment assistance programs, venture capital investments on behalf of the state's VC investment trust, private student loan lending, economic development loans and investments, and interagency administration agreements. Mark, you're a busy man. Really appreciate you taking the time today, and I ask you all to welcome Mark to the stage.
20 minutes, here we go. Thank you for having me today. It's a pleasure to be here. My name is Mark Conine. I'm the president of ADFA. What is ADFA? We're a state agency, part of the Department of Commerce. We don't get any state funding, so we don't get any of your tax dollars. We don't get any general revenue or special revenue. It's all from the fees that we generate. I'm appointed, or was appointed by Governor Hutchinson, former governor, reappointed by current governor, Governor Sanders. And so I want to also, we have also a board of directors that's appointed by the governor. And so I wanted to acknowledge our chairman of our board is Seth Mims from Specialized Real Estate. And so thank you for being here today, Seth. And so appointed by the governor. So what do? We do a lot of different things, and I'm going to spend most of my time talking about housing, okay? So let me get to it. I think you need to see this slide. Okay, so if you're looking at, So if you look at this, these are kind of some of the things we do. We do public finance work, which is we issue bonds for private businesses or governmental entities. We do private student loan lending. We do a lot of multifamily, single-family, affordable housing. We have some development finance work where we work with Arkansas Economic Development Commission with a bond guarantee fund. We can issue bonds for long-term fixed-rate debt for businesses. And then we do a single-family mortgage program. And if we have any bankers in the room, we work with almost all the lenders, mortgage lenders and bankers in the state. We did about $260 million last year, about $330 million the year before. And what do? The leader of that mortgage program is down payment assistance. Okay, and so that's one of the things we use for affordable housing is down payment assistance. Okay, and one of the things at the end, if I don't forget, I'll say it now, that I want to ask you for is feedback on, can we do better? Is there something else that we can do other than the programs that we currently have? Okay, we are in the process right now of working with one of the firms we do to restructure some of that to increase it, because with the increase of housing, especially in the area that we're in, to see if we can come up with a higher amount and then also an amount that can become forgivable, okay, for a higher income limit, actually. And so those are some of the things that we're trying to work through. But we're going to spend most of our time, I'm going to kind of skip through. Another thing we do is we administer the venture capital trust for the state. So think Shark Tank. And so when companies will come in and they'll come to us looking for venture capital funding, and normally it's a company that we're trying to either recruit to Arkansas or is already located here, and they're looking at hiring people and creating jobs, and so we do that as well. But I want to spend most of our time talking about affordable housing. That's kind of what we're here to do. When I think about affordable housing, I think about opportunity. All of us have had an opportunity at some point. It may have been close to home. It may have been given to us by a family member. It may have been given to us by somebody we know. The first job that we got, somebody took a chance on us. They took a risk on us. But all of us are looking for an opportunity. We all need an opportunity. A lot of people that are seeking out affordable housing, they're looking for an opportunity. They're looking for an opportunity to live somewhere that's safe, something that's sanitary, and something they can be proud of, right? Aren't you all, you guys like to show pride in your home or the place that you live. And people that are looking at affordable housing, they're doing the same things that you're doing, right? They're looking for somewhere they can call home and raise their family, right? And most oftentimes they're looking to move up, just like you may move up. They're looking to move up and get into a place where they can raise their children or live their life. And so they're looking for an opportunity. So we have a couple of different programs that we administer. And some of you guys, I see a few familiar faces, will know the programs that we do. One of the things that we do is we have home investment partnership dollars. Okay, and some of you guys may be familiar with that. And what can we do with these home dollars? Okay, they can stand on their own, or you can pair them with like tax credit money. And I'll talk about that in a minute. So what do these home investment dollars do? Well, they're federal dollars that are granted to us, okay, at ADFA, and then we, of course, disperse those funds out to developers. And they have, the main thing I want you to look at is at the very bottom. They have an income limitation on it, okay? So usually it's 60% of the area median income, okay? And so that's why, right, they fall into the affordable category. But so they're to assist home buyers, right, or they can be multifamily tenants. And so a lot of developers come to us and they will pair this with either tax credits, which I'll talk about in a minute, or they'll pair it with some type of first mortgage. That first mortgage could be at a lending institution. It could be with HUD, like a 221D4 loan, right? It can be from any different types of sources. You can pair it with equity or whatever you want. But there's a component to it, and that is that area median income. That they have to be, those tenants have to be at 60% or below, okay? We have a little bit of a backlog of home funds, so if there's any developers in the room, you know that we've increased those limits. When I started, it was $900,000. Now it's $3 million. That's quite the increase, right? And so it started at $900,000 when I started, and we're up to $3 million per project, okay? So home partnership dollars, I want you to remember that. This was actually a grant, but I just wanted to show you this. Normally the funds on developers, they're repayable. Okay, listen closely. Your first, if you went up to $1 million, it's at 1%. If you or up to $2 million, it's at 1%. Anything over $2 million up to $3 million, that's at 2%. So $2 to $3 million, that $1 million is at 2%. The first $2 million is at 1%. Okay, this was actually a grant project we did working with Habitat for Humanity in North Little Rock. And where you see at the end of the cul-de-sac, it was an old school. Okay, and they knocked down the school because it was drug activity. And then you see what we have here, and you can't see the other two homes. There's two more homes on the wings. And so you went from an abandoned school where there was drug activity to this. Okay, and that's some of the things that, you know, what we accomplished with home. We've done this a couple times. We've done it in Jonesboro as well. I'm gonna skip some of this. Okay, so home investment partnership dollars. Then you also have National Housing Trust Fund dollars, NHTF. Okay, same thing as home investment partnership dollars, except it's for 30% AMI. So you're getting into a pretty, you know, low income area at this point, right? These funds, right, you can get $1 million, but it's at 0%. 0%, okay? And I failed to mention you can match these with your first mortgage. So if you go out and get them a first mortgage and you get them 40 years, right? We can go up to 35. So you can get up to 35 years at 0% on National Housing Trust Fund dollars, okay? Keep in mind all of these projects you can mix. So you can have some market rate, and then you can come get some home dollars, and you can come get some NHTF money, right? And it's done by unit. So say you got a 50 unit complex, you might have 10 home units and, you know, 4 NHTF units, right? So it's not the entire development, okay? So National Housing Trust Fund, home investment partnership dollars. Okay, low-income housing tax credits. A lot of people know ADFA as the kind of the LIHTC shop, okay? You got two different kinds, 9% LIHTC, 4% LIHTC. 9% is a competitive round, okay? So you come in every March 1st, applications are due, you put in an application for a project, we score those applications. It's just like a teacher, okay? We score the applications, you get a set number of points, we rank them by points, we have no say in it. We've set it up where you fill out the application and you score what you score. It's like taking a test, right? We score those and then we start awarding those 9% tax credits until we're done. That's kind of the simplified version, okay? Those 9% tax credits will provide you about 70 to 75% of the equity for your project, okay? They also carry the 60% AMI limit, okay, for the entire project, okay? So you get LIHTC, you get 9% LIHTC, you're 60% for your entire multifamily unit, okay? So that's 9%. That's on a competitive round. And we get awarded, let's go to the next slide here. We get awarded about, $8.5 million a year. It's a little more than that. It was 12.5 previously, but there was some federal boosts that they took away anyway. So it's about $8.5, $9 million. And if you're unfamiliar with LIHTC, the way it works is we issue the tax credits. You take the tax credit and you go to an investor. And that investor is going to give you about 87 to 88 cents right now on the dollar. So you say, here's your tax credit, here's your federal tax credit, give me the money, show me the money. They give you the money, and then you take that and you go build your project. That investor is going to take that tax credit 1/10 over 10 years. Does that make sense? So they're going to take 1/10 of it the first year, 1/10 of it the second year, 1/10 of it the third year, until they get to 10/10, until they get to the 10 years, and then they're done, right? The investor's done. They got their tax credits, right? So those are discounted, and that provides you about 70 to 75% of your project, okay? So what have we done? We have about 450 tax credit deals right now, give or take, and then about 20,000 units of LIHTC, on the books right now. So it's a lot to keep up with. Now, let's talk about the 4%, okay? On the 4%, that's going to provide you about 35% of your project, equity for your project, okay? But here's the kicker. There's no competitive round. It just uses what we call a state volume cap. And so Arkansas gets allocated about $370 million right now in volume cap each year that can be used to issue private activity bonds, right? Anybody seen the Big River Steel deal or U.S. Steel going to Mississippi County? They used lots and lots of volume cap, okay? So High Bar, have you seen the deal about High Bar that's going in right next to U.S. Steel? We did the high bar deal, that was $330 million. US deal was $530 million tax exempt. And so they're using that private activity volume cap. 4% LIHTC deals use volume cap. Okay? How do you get volume cap? You ask for it. You put in an application and you say, I need some volume cap. I mean, it's pretty much that easy. Okay? So you ask for volume cap. So this is my PSA on 4% deals. So up here in Northwest Arkansas, a lot of new construction over the past decade. A lot of new construction. Well, there's also old stock sitting out there, right? Right? So around central Arkansas, Little Rock and North Little Rock area, we're seeing a lot of rehab. So taking these 40-year-old properties, 50-year-old properties, they're coming to us and say, give us some 4% LIHTC. So they get the 4% LIHTC and they say, can we have some home funds too? We say, sure, we'll give them some home funds, right? So we give them some home funds and they might get some National Housing Trust Fund dollars as well, okay? And then they'll pull those all together and pull all those funds together. You get them they'll get a first mortgage or get a HUD loan, and then all of a sudden, we got a project. And so we're going to go, we're going to take this old complex and we're going to rehab it. We're going to make it new, make it look new. That's going on a lot in central Arkansas. Up here, you've had land available, everything's hot, so a lot of new construction, right? So there's my PSA for, there's probably an opportunity here in Northwest Arkansas in some areas to rehab some current stock, right? And those are some projects that we can talk about. This is a deal in Little Rock. It was just a LIHTC deal, the peaks at Little Rock. Derek, our PR communications guy, was so excited. Seth knows him. He took this picture and he said, look, this is great. There's one building here that's done, and look, you can see the construction on the other. I don't know if it's that exciting, but he was excited about it. He was really excited about that. So that's a LIHTC property, you know. Another thing that we do on the affordable housing front is on the single family side, okay? And so on the single family side, what are we doing? Well, we're taking some of these home dollars that we get, right? And we're providing down payment assistance, okay? And so we're providing down payment. You can see the programs there. If you look at the middle on the DPA, so borrowers can get up to $15,000 on down payment assistance. They can use that for closing costs or, you know, to pay their down payment. They can use it whatever they want to, as long as it's just going towards the transaction. It's amortized over 10 years, and it carries the same interest rate as the first mortgage. There's no tricks or anything like that. It's a second mortgage, 10 years, carries the same interest rate, okay? That's the leader of the mortgage, FHA mortgage program that we do. And so we'll take some home dollars. Now on the bottom, you can see that we call this the ADDI, A-D-D-I. Some of you may be familiar with it. And so how that works is if you are up to 80% AMI, in the particular area that you're in, look at this, up to $25,000, it's a second mortgage with no payment, and it's forgivable over 10 years. Right? Forgivable over 10 years. If it's $15,000 or less, it's forgivable over 5 years. So you might say, well, what about if I move out of my house in 7 years? Okay? It's just netted out. You don't have to write us a check for it. It's just netted out of the deal. Okay? So less than $15,000, forgivable over 5 years, go up to 25, it's over 10 years. Okay. All right. We'll stop. Okay. So we got about 4 minutes left. So here's some of I want to share with you some challenges. So I go across, I go to Jonesboro. I come here. I go to El Dorado. Camden. Spent a lot of time in Camden lately. We got a lot of things going on in Camden with the industrial park there. And so I wanted to share some of the challenges that I hear with you, okay, that when I'm traveling around the state. But they have to be common among the whole state, or they don't make my list, okay? Number one is I saw we had on the attendance list some cities, people that work for some of the cities in Northwest Arkansas. So one of the things I hear from the developers is talking about working with the cities, okay? And so what I'm trying to get across here is we've got to collaborate among all of us about how to get these projects online faster. Now that's not pointing a finger at the developers or the cities or whoever it is. But a lot of the developers will share back and say, look, we're trying everything we can. The cities say, no, they're not trying everything they can. It's this back and forth thing. But at the end of the day, it's this collaboration we've got to work on, that if we want to get these units on the ground quickly, we've got to collaborate and work together. How do we get this done fast? Do we streamline it? I don't have all the answers. I'm just sharing you the challenges that I hear out there. Another one is incentives for rural areas. I deal a lot with elected officials in Little Rock, right? And you have elected officials, you've got lobbyists, you've got different things going on, and everybody has a focus on the rural areas. What are we going to do for the rural areas, right? So one of the challenges is how do we get developers interested in rural areas, right? How do we get developers? Because if I said, I want to show a show of hands, and I want to say, who wants to build in Northwest Arkansas? Or who wants to build off somewhere way off? I don't get any hands. I never get any hands when I ask that. I stop asking that question because I know what I'm going to get, right? They want to build in the areas that are easier to build in, where they can get the work done, get the supplies, and get it quickly. And that leads me right into the last challenge is this. What do we need to do from a state perspective to get market rate developers, you guys are market rate developers, interested in building affordable projects? And when I say interested, I mean incentives. What type of incentive do you need? How do you want it structured? What do you want to see? What keeps you out of it? Right? Because we have areas where we need people to go. We have areas that are ready to build the projects, right? But everyone is so busy. Or I meet with market rate developers and they say, well, there's not enough in it, or it's too difficult, or it takes too long. I totally get it. I'd say the same thing if I was on the other side, right? So my question to you is get in touch with me or get in touch with our office and say, you know what, if it looked more like this, I'd be interested. I mean, the worst we can say is no because of this federal regulation or something like that. Because if there's not something prohibit us from doing it, then we'll look at it. We'll look at it. Here's my, I only have one plea. As you guys know, we need affordable single-family housing. There's something out there called state and local fiscal recovery funds. I'm trying to run some of them down. And so we can do something across the state with them, right? But there is just a need for single-family house, and we're trying to figure out how we get it on the ground quickly. It's not only needed here, but it's needed all over the state. And so my question to you is, how do I get developers, market rate or affordable, how do I get them interested in going to areas outside of their comfort zone? What type of incentives is it going to take? Okay, so I'm asking you for some feedback. Okay, you give it to me today, email me, or reach out to our office, or however you want to do it. But I'm asking for your help. I'm asking for your help because you guys are the players. I say all great coaches listen to the players, right? And you're the players. You're the players. And so I want to hear from you about how we can get single-family affordable housing on the ground quickly. So that is all I have. So, you got questions, or we wait for them?
No, we'll take 3 questions, if there are any. Back here. While I'm making my way back there, Mark, what are the affordability commitments on the 4% deal you mentioned? What are you looking in exchange for that? Does that mirror the 9%?
Yeah, that mirrors the 9% just for a certain subset unit of it. It'll be up on a per unit basis.
Hi, I'm Carrie Perrin-Smith. I'm a JP, a Justice of the Peace up in Benton County. And one of the things that I hear is that we need rural water for developers to consider development. And we are discriminated against because of the prosperity of Bentonville and Rogers. And we have a ton of small communities that need rural water. And the dollar signs behind it are crazy. I don't know if you have a response for that, but I did want to make sure that that was on your radar today.
Yes. One of the things we do is we administer 2 programs for the Arkansas Natural Resource Commission. And you guys may be familiar with that, the 2 water programs that we do. And so we just did a $108 million bond deal, and we're about to do another one in about 4 months for another about 150. And so hopefully there will be money for some of those projects, because I know I've seen the list, and I cannot tell you how long the list is for rural water. It's long, but that's what that money is for. So hopefully that may get addressed. Like so.
I'm Jeff Cooperstein with the Walton College, and my question kind of piggybacks on the justices of the pieces. What can you guys do for infrastructure? So if you want affordable housing in places, infrastructure is a huge concern for developers.
Yeah, that's a good question. So one of the things that we're doing on the single family side, we can take these home dollars and we can come in and we can say, okay, Mr. and Ms. Developer, how about we go in and we'll give you all the money for the development, all the curb and gutter, all the lots, get them ready, build the houses, and then when you sell the homes, you pay us back, and then you drag a fee, right? And so on the infrastructure, we can help with the single family side. So we basically say, instead of a construction loan, we're just gonna give you this money, and it's just, 0%, We're gonna fund it all. And then you just pay us back when you sell the homes. Now, there's a big penalty, not a penalty, but you can't turn them into rental homes. You gotta try to sell them, right? And so you'll have all the incentive in the world because the payback gets real short, if you can't sell them, right? But up here, you shouldn't have any problem. I mean, what's that?
0%.
Yeah, it's just 0%. Yeah, it might be 1%, but it won't be higher than 1%. So we can fund all that infrastructure while you're putting all that in, and then you pay us back, we sell the houses.
Right.
Good?
Great.
Thank you
Mark.
guys. Thank you.
Thank you so much, Mark. Some great programs there that definitely need to be considered and utilized up here. Our next speaker is Adrian Hartman. Adrian comes with us from Colliers Mortgage, where he is a senior vice president. Adrian has more than 17 years of experience specializing in secondary and debt market solutions. Adrian is responsible for originating multifamily and healthcare loans across the country through the company's FHA, Fannie Mae, and Freddie Mac lending programs. In addition to those programs, Adrian offers debt solutions for other asset types, including hospitality, industrial, self-storage, through correspondent relationships with the life insurance companies and debt funds. Thank you for joining us today, and I wish you'd all welcome Adrian. Thank you.
Really appreciate the warm welcome. Is this on? Can you guys hear me okay? It sounds weird up here. Thanks everybody for taking time out of your busy schedules. Workforce housing, affordable housing has never been in more need of support, and really glad to see so many advocates here today and such a great turnout. So thank you. Duke covered a bit of what I do currently. My background is that I started in this space focused on multifamily debt about 17 years ago in 2006 at the lowest rung of the totem pole, working on loan processing, working my way through underwriting, and in doing that, always taking on the most challenging transactions. Brain damage makes you learn, so I would work on affordable deals, LIHTC projects, historic renovations, whatever I could do to learn and grow more. A lot of people didn't want to work on it, so it wasn't hard to get the deals assigned my way. That did me well as I grew into a production capacity and ventured off to learn more about agency production, which I did for years at Prudential, PGIM Real Estate, and now I'm with Colliers since March of 2022 after seeking out a more robust platform. I like to connect that I'm also a person too, not just like a debt nerd, always structuring deals. I'm blessed with a loving, supportive, ambitious wife of over 10 years, a 7-year-old son, 7-year-old daughter, 5-year-old son, a big outdoorsman. I love hunting, fishing, skiing. I have a duck hunting addiction, and I'm happy to host client meetings at the Duck Club anytime, November, December. Let's make it happen.
Be careful what you ask for.
I'm trying. It's so good for me too. So Colliers Mortgage is a subsidiary of Colliers Mortgage Holdings, and we have related entities under this umbrella that make us a great resource to essentially be a one-stop shop. That's what I'm trying to offer to my clients is I'm not trying to sell you something. I want you to come, let's have a discussion and figure things out. So one entity that we utilize that's related is called Colliers Funding. It's a bank syndication platform. So the ability to offer clients banking capabilities without geographic constraints or max loan amounts In these times, banking is tough, but we still see some activity for bridge and construction through Colliers funding. A second entity that we leverage is called Colliers Securities. I generally work with the securities team whenever we're doing equity raises or working on affordable projects where tax credit syndication may be required. And the fourth piece of the puzzle is Colliers Insurance Agency, not a guessing game there. That it gives us the ability to quote insurance for our clients. Insurance has never been kind of more brutal. It's a real thorn in the side when you're sizing deals. So I can always look at reach into that pocket and see if I can get a more competitive price to try to make the deal work. Quickly, I don't really understand the audience all that well. I saw the attendee list of names, but just curious by a show of hands, how many of you actively own, manage, develop, or oversee five or more multifamily units? Right on. I got a few of you. All right. Then the definitions will help. So 50 or more? Do we have anybody with 50 or more in here? Awesome. Okay. Colliers Mortgage, again, we focus on long-term fixed rate non-recourse debt solutions, and our licenses are through agency, that's Fannie Freddie, USDA, or HUD. We also have a robust mortgage banking platform, and what does that mean? It means that we access third-party capital. Think about life companies, debt funds, private capital, so we can get creative and find solutions. And these times have become critically important, figuring out ways to get deals done. We service what we fund, right? So we're there for service after the sale, and we do this on a very large national level. I've closed loans from Alaska to Puerto Rico. So, not just to a geography, we can follow the relationship anywhere. Just so I don't confuse people with terminology that is day-to-day to me, but maybe Chinese to you guys, I wanted to define a couple of terms. Non-recourse debt, if you guys are not familiar with that term, you need to be if you're in the ownership space. It frees up your borrowing capability, it de-risks overall, and it essentially means that in the event of default or foreclosure, they can only come for the subject asset. They cannot come for your personal assets. So if you want to grow and grow big, use non-recourse debt, right? The next three terms are really mortgage constraints, and they're ratios that we use to gauge risk. Okay, so DCR, DSCR, that stands for debt coverage ratio. It's a measure of your NOI, your net operating income, over your debt service. Generally, lenders want to see that at a ratio of 125, and that's currently setting the upper lending limit today. Next is LTV or LTVR, loan to value ratio. That's just a measure of your loan to your current appraised market value, and upper limits can reach up to 80 to 85% on some executions. Usually today, due to DCR constraints, we're seeing lower leverage, more towards 70, 65% depending upon the deal. LTC, that stands for loan to cost. It's a measure of your debt, right, your loan, over your cost basis. And ultimately, owners want to get where they have no equity in the deal. That's a great goal. Generally, lenders these days want to see some skin in the game. So we measure that as well and make sure that coming through the door, there is some actual equity in the deal. There can be exceptions when you get creative and Mark had great solutions too. Maybe you can get skinnier on actual skin in the game through truly pairing with LIHTC deals. I thought I'd tell a quick story because throwing terms at you guys might go right over your head. I think this hopefully hits home a little bit better. It's very recent, a loan that I locked about a week ago. A client was introduced to me. He builds multifamily projects in a tertiary market outside of St. Louis. And he grew like a lot of developers do, offering single family homes and then subdivisions and then multifamily projects. And in doing this, he'd done this all with local community banks. Well, that's great to a point, right? Until those banks hit their max lending limit, right? Then what do? Well, you need to talk to somebody else, right? So an existing client passed him my way. I was, of course, happy to help him out, right? And I looked through his portfolio, figured out which bank I needed to free up capacity on, found a project of $5 million, and I got him his first loan, which is a great loan for starting down the non-recourse path called Freddie's Small Balance Loan. It was a $5 million deal. He got cash out whereby he had nothing left in terms of his cost basis in the deal, 3 years of interest only on a 10-year fixed term with 30-year amort. So he did really good. His name is, I'll say Ed right now just to make it up for confidentiality, but Ed was happy, right? Fast forward earlier this year, Ed says, Adrian, I'm delivering 108 units this year. I talked to my bank, and before we had a good plan for my takeout, they were gonna put me in the mini perm. But now the mini perm is over 8%. I'm a little concerned. I understand, Duke. Yeah, I understand, Ed. Sorry, I was looking at you. 8% is scary. We can figure this out. Well, I haven't delivered all my units yet, right? Well, hang on. There's a way. Agencies have become a little more flexible, bending on the 90 for 90 rule, 90% occupancy for 90 days. There is a way to take up deals that are in lease up, even with just 1 month's occupancy. And so I hope this hits home with the developers here that there is a way out for your deal. Plan on it early. If you're delivering units now from a sub-rehab, a reno play, new construction, and you're not sure what you're gonna do, start talking to your lender early. Figure this out, right? Figure out the path out of what the bank's about to hit you with, because it's not gonna feel good when they do. So we tracked it, we figured out a solution for Ed, and ultimately that's what you see here on this screen, right? He came to me, and we were able to structure a deal that hopefully you can readily see in the difference column is far superior. We were able to give him much higher proceeds through a Fannie Mae conventional loan, right? We started this in and out in 60 days, inside of 60 days. He yielded over $600K higher in proceeds, did significantly better in terms of his interest rate. And because of the lower interest rate and the 30-year amort versus the 25 the bank was gonna give him, we had a higher loan amount to offer him. We also were able to give him 5 years of interest only. He could have taken 10. He could have had full term IO. Some people have never even heard of such a thing. I mean, to me, it's kind of normal. You know, if the deal is right and the leverage is right, you could have full term IO, non-recourse. That was the other cherry for Ed, was freeing up that bank's lending capability, lets him use that friendly bank's construction capabilities on his next deals, right? So I love using banks for what they're good at, kind of quick, easy construction, right, if the price is right. So that's exactly what Ed did here, and hopefully it's something that can stick with you guys as a tool to get out of something you might be in. You know, the loss I have here, right, is the fee. Right? Somebody could say, well, you cost more. Yeah, we did. We gave him a way better deal. He's able to make back all that money in a very short period of time with the terms that we offer. So we crushed that bank deal, right? I'm proud of it, excited about it, glad Ed can get a win. So I mentioned a common deal type, and I'm going to cover a few today that people use routinely to me. This is to me sort of an entry-level deal called a small balance loan. Both Fannie and Freddie offer these small balance loans. I don't know it's that small. The loan amount ranges from 1 to 7.5 million, and 7.5 is getting up there. So, but it fits within the bucket. It's a streamlined process with simplified loan docs and processing overall. Rates today on this execution are about mid sixes to high sixes. Well, you get discounts for affordability, so that's a big thing. All of the solutions we offer, you get preferred pricing when we can say you're affordable at some percentage of AMI, right? So it pairs very nicely with workforce housing. You can be in and out of as quick as a bank deal, but why I love the Freddie Mac Small Balance Program is that your rate is secured when you sign your term sheet. In a rising rate environment or a volatile rate environment, who knows what's going to happen? You can get your whole deal blown up just like that. So to be able to sign and know what you're getting and then put your $10,000 down and get into the process, it gives you a little bit of relief. So I do like that about the SBL program. This is a great one to start to use. Of everything we have is non-recourse, right? So this is no different. The next level up is conventional agency, and that includes Fannie Mae and Freddie Mac. Think $5 million and up. This is very similar to the Freddie Small Balance Program I just highlighted. Maybe a few more bells and whistles. Full term IO tends to be more common. Better pricing overall. So rates today on conventional agency are high fives to low sixes instead of mid sixes to high sixes. So it prices better, and there are even more incentives, right, for affordable takeouts. This is what you use on a purchase or refi. This is not a new construction tool. Neither was the SBL. You can be in and out inside of 60 days, and you can do streamlined rate locks when you're in a volatile rate environment like we are today. I I won't go into the full pros and cons because I hope you're picking them up. I could talk about this for kind of like hours. Try to get it in 15, right? But I'm hoping you're picking up some of the pros just from the prior slides. Long-term fixed rate, a variety of term structures, 5, 7, 10-year hybrid structures, floating, interest-only capabilities, non-recourse, right? The catchphrase. So I won't go into crazy detail on the pros and cons. But what I do and what Duke had me in mind for when he asked me to come down here was to talk about HUD. HUD isn't a beast unto itself, right? Some people have heard things, they don't know what to think. Somebody had a bad experience. My goal is to be your shepherd through the process, right? Make sure that you get what you came for. We are a top 10 lender in the nation, and having a lender that is well established and knows their stuff is kind of important because we have the ability to pick up the phone and leverage our relationships with the HUD offices. A friendly approach when you need somebody to maybe bend for you a little bit. This is just a quick overview of the programs that we cover. The most common program is, of course, the HUD 223F refinance program. But HUD does have a new construction program, which is the 221D4 new construction program that offers financing for sub-rehab and new construction. And then the A7, it also comes into quite a bit of popularity when rates go down. It's a real benefit of the HUD program is that you can come back in for a streamlined rate reduction. Let's say you locked in today at 7%, or our rates aren't that high, at 5.90, and in the future rates are 4%. You can come back in with the A7 and drop your rate very simply, easily, affordably to 4% if that's where the environment is at the time. This is an overview of the 223F program. The 223F program is pretty awesome, right? It offers 35-year fixed rate, fully amortizing, non-recourse debt, right? No other program offers 35 years fixed rate, period. And in addition, no other program offers the leverage that this offers, up to 85% on market rate projects, up to 90% on affordable projects. The DCR on this, 117 on a market rate deal and 111 on an affordable deal. That just means higher leverage for you, more loan dollars, right? Less equity and the ability to make things happen. So those to me are the big highlights of the 223F program. It's also fully assumable, as are all of our other programs too, right? So somebody says, what do I need to be in it for 35 years for? Well, it has value when the interest rate's very low, and somebody can assume that debt later. So I like to make sure I point that out. And the final program where I hope that client Ed can graduate to next, right, after running through the SBL conventional agency, is the D4, right? This is where I hope to get people as they sort of mature in their path, using the D4 to develop multifamily assets, workforce housing, market rate. It works for them all. It works a little differently for them all. There are certainly better pricing incentives on workforce housing and affordable housing. The D4 is also awesome. 40-year fixed rate deal. I mean, this is kind of crazy, right? With up to 3 years of interest only during construction. Your perm rate is fixed when your construction rate is set. So you don't wonder, what's going to happen to me when my construction note matures? You already know. You can model it. We understand. I will point out that it does take some time, right? You have to have the right team with you to get a D4 done. There's no question about that. It could take 10 to 12 months. To me, that's the biggest pitfall of doing a D4, which is less of a big deal if you start the conversation proactively with your lending partner when you start to identify the site. It's not always great when I answer the call and they say, I have a site shovel ready. Adrian, what are we going to do? Well, not the D4. We're going to do something a little bit different here, right? But when somebody's in an area and they know they're trying to build, you should absolutely be modeling the D4 every time you're doing a development deal, especially in these conditions. And D4 is the go-to resource for new construction when we're in this sort of environment. I couldn't be a bigger proponent for the program, and I think that it can make a world of difference for delivering affordable housing, and pairs very nicely when you start to build a capital stack with what Mark. pros and cons. I tried to cover many of the pros in the prior slide. And I actually have points against every con here that I could go into in detail. I don't necessarily have the time here. But I want to leave you guys with some key takeaways. First of all, non-recourse debt should be a part of your strategy. It decreases your risk and increases your ability to grow. So understand how to access non-recourse debt. Secondly, right, you do have options. You have a lot of options. So it's important to kind of keep your eyes open and be aware of them. Options are changing all day, every day, right? We see debt providers coming and going to the market, and we keep our finger on the pulse as an institution. We're in crazy times, right? Volatility seems to be the name of the game. If you watch rates like me, I hope you don't pull your hair out. Have a plan. Be proactive. Talk to your debt partner before you need to, and model how the end destination looks before you get there. Get an idea of what you're driving up towards, right? We can model that, we can figure it out, and when we're proactive in that, we can make sure we're moving quickly so that you're not blindsided by something. And finally, I hope I've impressed that, Colliers Mortgage has the platform, expertise, experience, right, to be that one-stop shop and resource for you all. And I hope you'll take me up on that. I've got a QR code here that includes my contact information. If you scan that, like an email will open and actually the dialogue will begin. But this is a very quick and simple way to connect. And I would really love the opportunity to connect with you and be a resource. Thank you.
Great. Thank you so much, Adrian. And just so you're aware, I think we're going to circulate the slides to everyone. I know, all of our presenters packed a lot of information in those. And so want those to be a resource for each of you. We got time for just a question or two. Are there any? Oh, all the way across the
Yeah. Multi-family, mixed use, what about mixed use projects?
Yeah, there's
where
tolerance.
you have residential and commercial.
As long as that 20% is readily approvable, right? We can push with the waiver, but generally the programs are designed for housing and not necessarily retail. So as long as that proportion of retail to residential doesn't exceed really the upper limit of 30%, right, with the waiver, then you're okay. 20%, pretty easy to do.
Adrian, I have one question. Are there, as someone who's pushing many of our developers to think bigger, push the region to think bigger, are there loan limits on, say, the D4?
That's a great point, right? There's not. And so in traditional banking and lending, right, your max loan amount is determined by your net worth. So this enables developers to do deals that are much larger than perhaps their balance sheets can support. So let's say you're a $10 million company or individual, right? You can do a $50 million deal, right? Try doing that with your bank with just $10 million. Good luck, right? So this allows you to swing for the fences, right? Do bigger projects.
All right, no more questions. Thank you so much,
Thank you.
Adrian. Right, our last speaker is Ron Vanden Handel. Did I get that right, Ron?
Yes, close enough.
You
I'll take
can
it.
correct it. He can correct the record when he comes up. Ron's the managing director with Preston Hollow Community Capital. Ron joined Preston Hollow in 2020 after 14 years in the municipal capital markets group at Deutsche Bank, where he was head of origination and distribution, focusing on transactions involving higher yield and bespoke credits across municipal sectors. Over the course of his 30-year career in municipal markets, Ron has held a wide variety of roles, including responsibilities for sales, trading, structuring, and origination. I'd like you all to welcome Ron to the stage. Thank you.
Can you hear me? So it's encouraging to see so many people here. Someone else said that. It's funny, I texted Isabel, who you probably met coming in. She basically orchestrated the logistics for all this. I texted her yesterday saying, should I print 20 or 30 of my decks so I can pass them out when I get there? And last night at like 8:30, I'm sitting on the couch, relaxing, and I get a text back from Isabel. No, we'll have screens. There's gonna be about 150 people. And I'm like, okay, I should put some, I'm laying on the couch, the dog's laying next to me, I better put some thought into what I'm gonna say. And then she texts, and I see it here, there's a monitor here that we can see. And then she texts, and we have a confidence monitor. That's interesting, which is what this thing is, where you can see it yourself. I'm thinking to myself, so you're gonna monitor like people's confidence in what I say? You're gonna monitor how confident I look? Like, I better wear a jacket. Anyway, happy to see so many people interested in workforce housing. I am, as Duke said, I'm a longtime municipal professional. I'm with a firm called Preston Community Capital. And I'm here to talk about the municipal market's solution to financing workforce housing. So first, a little bit about us and what we do. We're a specialty lender based in Dallas, Texas. We focus on the municipal market. Our business is really building partnerships with municipalities and not-for-profits to deliver financing solutions for projects. We have, you can see from the deck here, 150 unique customers. We've loaned out over almost $5 billion since our inception in 2014. We currently have a $2.7 billion portfolio. All of that consists of municipal bond deals that we originated, structured, and purchased ourselves in their entirety and hold on our books. We buy transactions anywhere from 10 or 15 million to, I think our largest was 300 million for Howard University. It should be clear, but I always have to make it really clear. We're not an intermediary, we are capital. So our job is to provide capital, not to get hired for a fee to go find you capital. And I should also say, we're very selective, very distinct from the government agencies who are trying to provide a broad solution that applies in many places as possible. We're very selective. We are not all things to all people. We like to do deals where there's a municipality involved, acts to make something happen, to solve a problem. And we like that incentive because it fits with our mission, but it's also, from a risk standpoint, it presents an appealing risk profile. So our team is really, it consists of people who were executives at other firms on Wall Street, focused on high-yield munis for all their career, and came down to Dallas to join Preston over the last 5-6 years from places like Morgan Stanley, Goldman Sachs, Bank of America, in my case from Deutsche Bank. So it's probably good to, given sort of the breadth of the audience, to back up a little bit and just sort of talk about municipal debt in the context that I'm using it. I think most people, when they hear municipal debt, municipal bonds, municipal deals, they think government-issued, government-backed securities. And certainly there are, I noticed on the attendee list, a lot of people from cities and other muni entities. I don't want anybody getting nervous that I'm after your balance sheet, because that's not what we do. To think that is actually correct. The muni market's a $4 trillion market, and more than 90% of it is governmental deals, water and sewer revenues, general obligations of the city or state or county or something like that. We focus on that small subset, which is still a very large market, of deals where the debt is backed by the project itself, not backed by a municipality providing a credit guarantee or providing their balance sheet. So, specifically workforce housing. And it's great what Mark went through is very helpful because I can cut 4 minutes out of my presentation explaining what LIHTC is, explaining what some of these other programs are. High level, and a lot of you already know this, but high level, if you want to finance deeply affordable development, there are federal government subsidies to do that, and you've been through all of them way more eloquently than I could even come close to. But it doesn't fulfill the entire need that's out there, but it provides a lot of development and deals get done every year, and there is a path, right? There's a well-worn path. If you are building market rate housing, then deals either pencil or they don't, but deals pencil. And over the last decade, it's been a very good time to be in that business, obviously, because of the growth and rent growth and all of that everyone here already knows. The gap, and people call it the missing middle, is that, and you did a great job explaining AMI, or median income, right? So LIHTC is sort of the high bound, the higher income bound of affordable subsidies from the federal government, and that stops at 60% of the area median income. So if you're below 60, there are subsidies. If you're at market, which is usually 120 or 140% of the area median income, it pencils and the deal carries itself. That missing middle is between 80 and 120, 80 and 140, 80 to 100. And the reason it doesn't exist, the reason we don't have it, the reason there's a dire shortage, the reason teachers and municipal employees and firefighters and first responders are living in a lot of areas in 1970s vintage apartments, and because no one has built to cater to that group. And so that's what these structures that the municipal market has developed are designed to do. They're really targeting 80 to 120% of AMI. And this really started in 2021 in California. There were a series of deals done totaling $8 billion where municipal entities would go into the market and buy recently built stabilized assets, take them into municipal ownership, and if a muni owns it, then there's no property tax. So immediately you get a property tax abatement, which increases the net operating income of the project. And then they would impose rent restrictions. And the California deals were all a third, 80%, 100%, 120%. Again, a long series of deals got done. A lot of volume was sold into the muni market. There were intermediaries who would arrange these deals, structure a bond deal, and then sell it into the public municipal bond market. That worked very well until the market destabilized as rates went up and the environment's not quite the same. But the structure works really well, actually. And after the deals were done in California, deals have been done in Texas, deals have been done in the Carolinas, Florida. There are other deals in the market sort of brewing right now. It's a structure that I think has taken hold and will finance a lot of multifamily housing in the years to come. So it's something that I'm here to sort of explain to you. So here's the structure. It's not that complicated. This is boxes and arrows that hopefully make it a little bit more simple. Again, the municipality can own the asset, or you can put in a not-for-profit in a partnership with the municipality. A lot of municipalities will say, we don't want the legal liability of owning an asset. In reality, you can ring-fence that with LLCs. It's not actually that problematic, but maybe municipalities concerned about reputation risk or some other issues on the periphery, it is possible to bring in a not-for-profit and enter into a partnership and still achieve the property tax abatement. The structure that I'm illustrating here is a deal that we would do. And so in my example in California, the deals were arranged and then somebody went out into the public market to raise capital by selling the bonds. In our deals, we structure them to suit our own needs. We buy them all into our own balance sheet and we hold them. Typically, when we do this, we'll put, it looks a lot like a traditional capital stack on a multifamily deal, in that you normally have senior debt and then you have equity. You normally have a couple tiers of equity. In our structure, we structure senior debt and then we'll buy subordinated debt, which takes the place of equity. Many times, a developer will also want to invest, and so we can have several tiers or a couple tiers of subordinated debt so that the developer can also be involved and participate in the upside. And for those of you who are financing geeks, Adrian, you can, the subordinated bonds do not have a fixed amortization schedule. So they're called a payment in kind bond, which is to say when cash flow is available to pay debt service, it pays it. When cash flow isn't, then the outstanding principal amount just grows. And so this is just, it's probably easiest to explain through a case study. This is the deal that we did in San Antonio, Texas. This was ground up development. It was a private developer who controlled the site and wanted to build a 300-unit apartment building. They negotiated a deal with a public entity, the San Antonio Housing Trust. The San Antonio Housing Trust had very demanding objectives. They were looking for a high level of affordability and also wanted economic upside from the project. And this is sort of I think the key kernel from all that I have to say. So the way the structure works is the San Antonio Housing Trust owns it. They issue bonds, which provide all the capital to build the project. We buy all of the bonds, hold them on our balance sheet. And the Housing Trust still owns the asset, right? So the debt service has to be paid. But they have a call feature in 15 years. And after all the debt is paid off, whether it's called or whether it's amortized down, the Housing Trust owns the asset free and clear. So if you're a city or a municipal entity, part of the takeaway there is, from a political standpoint, property tax abatement is necessary, certainly, to make deals pencil. So that's something that you, the city, are going to have to provide either way, right? I mean, the way I look at it, the deals don't pencil. They need governmental help. So economic development authorities, cities, counties, public entities that's part of the public mission, right? It serves a community benefit. I talk to them every day. They're all out there trying to find ways to solve this, and many of them have found ways to capitalize these deals and have found a path to property tax abatement, and they're ready to start making these investments or these subsidies. I think what it really comes down to is if you do it in this structure with the municipal debt, you make an investment with your property tax abatement. You make an investment with whatever cash you have to provide to fill the gap, and you own it. And so when 10 years from now, it's gone up because you're in Northwest Arkansas, because it's booming, because there's all kinds of growth, because real estate is going to inflate, then you'll be able to monetize that. The public will be able to monetize that and then redeploy the funds to build more housing and or fulfill other needs. The alternative to that is you can provide a subsidy, which is it's the same thing that you're providing, right? It's the property tax abatement, it's cash, it's other instruments to fill the gap. But in that case, the subsidy is out the door, private capital finances the rest of it, and the upside will go to the private investors, which, as it should, they're taking risk, right? I mean, all of that is as it should be. But again, I think if you're looking at it from a long-term perspective, if you're a municipality, the investment itself from an economic standpoint makes sense. It's a good investment, and I can show you the IRRs and demonstrate to you, in any particular case. But I think the broader takeaway is it's a longer-term horizon investment, and who better to take that than a municipality, quite frankly, especially when you're achieving the social goals at the same time, all of your policy objectives. And the other thing I would say that I should have touched on earlier is municipal debt is also more efficient, just because it's tax-free, right? I mean, we follow rules on these deals that the federal government has put in place to enable tax-exempt debt to finance these projects. So if you think about it at a high level, if I'm trying to invest in something that I think has a 10% risk to it, and I'm paying tax on that, so I'm going to buy that investment at 10%. I'm going to pay, let's say, 40% tax. The net to me is going to be 6% after tax. So it isn't quite this simple in the real world, but from a mathematical standpoint, if you think about that, that would mean that the 10% taxable investment, that the cost of capital for a project at 10%, to pick a round number, is really indifferent with 6% in a muni structure because it's tax exempt. So there's an inherent efficiency there that can be taken advantage of by using these structures. Again, it facilitates the abatement and it creates that efficiency. And I think the ability on the part of governments to use this structure to instigate development and then also benefit from it in the long term so they can recycle their dollars and put them back out and build more. It does feel like it's catching fire. There are more and more deals pop up every month, and it's something that hopefully the city people in the room are keen to be aware of and at least look into. That's it for me.
Are there, excuse me, any questions specifically for Ron before we move away from this? I have one. Ron, you mentioned a lot about like city involvement. Are there other types of entities that could potentially play that role with this structure?
Yes, I mean, one thing that we've seen, and we've done it on deals, is there are all kinds of nonprofits. There are what I like to call mission-based nonprofits, that have been operating for years and years. Some of them have balance sheets. They like to participate in these deals. Great, love to work with people like that. There are also nonprofits for rent. There's just a legal structure that you can bring in for a cost and establish nonprofit ownership. And they also have asset management capabilities. So that is often a good option for a municipality that wants to sponsor a deal like this, but doesn't want to, is queasy about perhaps the reputational risk or some other aspect of having it be public knowledge that they own the project. And so you can still sponsor it. You can still cut a deal with a nonprofit that says in 10 years I have the right to buy it. Governments can do that. And so you can still get the economic upside.
So I had a question about your bonds. When the city agreed to issue them, were they aware that you were going to purchase all 100%? Part one. Part two is, have you seen where cities would issue the bonds knowing that maybe you'd purchase a portion of them and the rest would be issued to other people? Just curious about the bond process.
Yeah.
The city issue.
Yeah. Well, I mean, everything I do, everybody's always aware of everything. Let's be clear. I mean, there's no jumping out of the cake at the end for me. That's a short-term strategy. And I'm old, no, but actually they like that. I mean, it's a big selling point because the reality is some of these deals where I'll call them intermediaries have arranged the transaction and then sort of gone out to the market and said, "Where's my money?" And the market has said no, because, I mean, look what's happened the past couple of months, right? It's been come closer to the camera. Makes me nervous somehow. So I think our municipality partners are very happy that we're buying all that. And you know what else? They're happy that we're holding it long term, because if, and I always tell them, they say, I know, I'm going to take it over in 15 years, right? That's great. I love that. How do I know it's going to be maintained along the way, right? How do I know this isn't going to be dilapidated housing when I get it in 15 years? And the simple answer is, it's not because we're nice guys or because we promised you. If we give you $100 million for this asset, you can be very well assured we're taking care of it. We're going to be out there, all the time. We will take care of it for sure. So, and I think the municipalities like that.
Yeah.
Just a second, one more question.
I was just curious about the property tax abatement. In Arkansas, we tried to do TIF districts in the mid-2000s. In Arkansas, the Supreme Court, through the city of Fayetteville, school districts, basically that millage you can't use. So when you say property tax abatement, you're talking about the city, county portion, or I'm just confused about where that abatement is occurring, or those funds are being generated.
Yes.
Thanks.
It's good. It's a great question, and it comes up. So the short answer is whatever we can get and whatever it takes to make the deal pencil. And in reality, some states, in California, it's a well-worn path. It's called the Joint Powers Authority structure, where it is 100% property tax abatement. In Texas, you use Housing Finance Corps, and it's also 100% property tax abatement. Now, other places, they're more one-off, where there's no structure, statewide structure to use, where people are just getting into rooms and negotiating how it's going to be, right? And so it can be whatever it has to be, is the long answer. In most of these deals, it requires 100% abatement because the revenue doesn't cover the cost of construction.
Any other questions for Ron?
Is there a target size municipality that the structure does or doesn't stops working?
I don't think of it as a target size from a municipality standpoint. So there's a market around this. I can't speak for all of that. I can speak for what we would do. And so the way we look at it, I mean, it's very simple. We're going to want to make sure there's demand for those housing units, right? And so would it work in a rural area? I think it'd be challenging. Would it work in a rural area with 3 large employers? Probably. I don't know. But it's just going to be very common sense from our standpoint on the risk. And then the other sort of size component is it really does take 200 units to get economies of scale to make these multifamily projects work. All of that can be fixed with money, right? So, I mean, we're just going to look at it very logically, right? And again, we love partnering with municipalities. If there's a municipality that says we really want this to come to fruition, it doesn't pencil at 50 units, but if I put up 30% of the capital, me, Mr. Municipality, I put up 30% of the capital, then it does pencil, then, we're interested in that. Hope that answers the question.
Any other questions?
Thank you.
All right, thank you, Ron. We had originally planned to bring these guys back up and open them up for some other questions. If they don't mind, I think it'd be just as easy for them to take any questions here, maybe just stand up. Are there any other questions from or for any of our presenters? Thoroughly confused and overwhelmed, I get it.
So my question is for Mark. I was gonna ask you, from your state perspective, does Northwest Arkansas use your funding as much as other parts of the state?
The answer is yes. I mean, from the LIHTC perspective and the other home partnership dollars in NHTF, we've seen a trend over probably the last, say, 5 to 7 years more into Northwest Arkansas and Central Arkansas. That's correct, yes.
One more question.
That's another question for Mark. As far as what the organization is doing, is there any momentum towards making sure that we are incentivizing developments that use existing infrastructure instead of building new infrastructure that the city then has to maintain, or denser housing that's going to be better for land value per acre for the city into the future?
That's a good question. Yeah, we've seen an uptick in, let's go back about 5 years ago. We did know 4% LIHTC deals, okay? Last year we closed like 5. And the year before that we closed about 5. And then so, yes, we've seen an uptick. And those are almost exclusively rehab. Don't work real well with new construction. And so I think the answer is yes. We've seen and mostly just because of, awareness. I mean, to be real honest, it's just awareness that, when people become aware of it, and they say, and as land has become scarce in certain areas, they're saying, well, we can't, this land is too high, or we can't find the right land, or it's too expensive, it doesn't work. And so they're kind of pushed towards, rehab. So yeah, we've seen an uptick. We've probably got 6 applications right now, either underwriting or sitting there with, various things going on. So yeah, it's pretty robust now.
This question may be for you, I'm not sure who the best answer this, but this has been a great primer. I sense the learning curve is steep, and I'm just wondering, if this isn't your lane and you want to start to move into this direction, what's the next step?
I'm happy to take that and be a resource to make connections. I think all 3 of these gentlemen would be open to follow-up conversations and get further into the weeds with anyone who's interested. But correct me if I'm wrong. Okay. Any other questions? Seeing none, I just want to mention, again, look for a survey. We'll have a video of today's presentation in that. Please look for more information on our last speaker series event of this year that's going to happen in November. You'll get invited to that. We have your email now, so we know where to find you. And thank you as always for your time and attention. And don't hesitate to reach out if you have any questions. We will include the slides from today in that follow-up email, and we'll be sure there's contact information in there as well. So thank you very much.